In any normal world, a year where the S&P 500 went up by 19% would be like, wow, this was a great year for the stock market. And yet, no one seems particularly happy about it.
People are a little nervous that the S&P's performance is so heavily dependent on AI.
One of the stories also of 2025 is just that tariffs weren't as bad.
The 39% tariffs on Switzerland, they got cut like more than in half. They're down to like 15%. So all of those Swiss watch companies can breathe again. Phew. I know you were worried about them.
I was very worried about the watches. Let's talk about Berkshire-Hathaway because they're still really big.
They're a $1 trillion company. Like, it's not just the mega cap tech stocks. There's also now a mega cap conglomerate.
They're super conglomerate. I just made that up.
Hello and welcome to Slate Money, your guide to the business and finance news of the week. I'm Felix Salmon of Bloomberg. I'm here with Elizabeth Spiers of the New York Times.
Hello.
I'm here with Emily Peck of Axios.
Hey, Felix.
And we are in 2026. Finally, we have put 25 behind us. We never need to think about it ever again. Wait, actually, we're going to spend the whole episode talking about 2025. It was a really interesting year. A lot of important things happened, and we just want to talk about what happened in the stock market, which was kind of surprising, what happened in the deal-making market, what's going on with Berkshire-Hathaway, and yeah, maybe if we understand what happened last year, we kind of have slightly clearer eyes going into this one. It's a meaty, all-encompassing conversation, and it is coming up on Slate Money.
Welcome to the new year.
Emily, can you sum up 2025 in like a noise with your lips?
I mean, I believe the sound was so is that good? Are we on? Are we recording?
We are recording, and I want to talk about stonks, and I want to talk about that take, which is a take that I've seen quite a lot, which is in any normal world, a year where the S&P 500 went up by 19% or whatever it was, would be like, wow, that's amazing. This was a great year for the stock market. And yet, no one seems particularly happy about it. And I think there are two main reasons, well, three if you include Trump, but we don't like talking about Trump around these parts. So two main reasons, which is, number one, that stock market investors just want to make the most amount of money regardless. And it turns out that if you were invested anywhere else in the world, you would have made more. So the European stock markets, the Asian stock markets, or even the Brazilian stock markets, they all outperformed America. So America, although it did well in absolute terms, feels like it underperformed the rest of the world. Well, it actually did underperform the rest of the world. And people are like, ooh. And then the other part of it, which we'll get to a little bit later, I'm sure, is the dollar. That, you know, if you're not a dollar-based investor, then most of those gains get wiped out by the decrease in the value of the dollar. So like the stocks go up in dollar terms, but then the dollar goes down in euro terms or in peso terms, whatever. And then, so like net, your gains in the US seem pretty meh.
Well, that, and also I think people are a little nervous that the S&P's performance is so heavily dependent on AI.
Yeah, I'd say that's another factor there. Everything I read is like, well, if not for AI, the economy would have been much worse last year. If not for AI, the stock market wouldn't have seen any gains. If you take the AI heavy companies out of the stock market, it doesn't look as impressive.
Well, I mean, yeah, but like in order to believe that story, you have to consider, you know, Google and Apple to be AI stocks, which I just don't think that they are. I mean, obviously these companies are trying to move into AI and adopt AI with varying degrees of success. But like, I really don't think that someone going out there and buying shares of Apple is like, I'm making a bet on AI.
I think they are. I mean, not entirely, but all those stocks are very expensive right now. And I think they've gotten more expensive because they're making bets on AI. Not that they wouldn't have been dominating the index in the absence of AI, but I do think it's driven a lot more value for them than, if they weren't doing
So
that.
sure, but but Elizabeth, my point is you can say that about almost any stock, right? Like every company in the S&P 500 is out there talking loudly about its AI strategy and how it's going to become much more efficient and productive and yada, yada, yada because of AI, Apple included. And you can definitely make some kind of a counterfactual case that, Apple or any other stock would be less expensive were they not out there shouting so loudly about AI. But that's true of everyone.
Were that the case, though, wouldn't things like the Russell 2000 would be up more than 12%?
Well, that's why I said S&P 500 and not Russell 2000.
But also the Magnificent Seven account for about a third of the growth this year. So if you take them out and then look at the rest of the index, what's the growth level? And would that be normal?
No, you're absolutely right, Elizabeth. And this is exactly why I'm trying to make this distinction between AI stocks on the one hand and the Mag 7 on the other, right? It is true that there is a huge amount of capex in AI. If you look at that 4.3% GDP figure that we just had, a huge amount of that is AI. The economy is reliant, and the stock market, and to some degree, is reliant on the kind of optimism that is engendered by AI. And yes, there is a lot of concentration in the stock market, and the mega cap tech stocks are a really large proportion of all market capitalization. All of these things are true. The only thing I'm pushing back on is this idea that the mega cap tech stocks are ipso facto AI stocks. I think virtually all large cap stocks have an AI component to them, but the number of actual AI stocks in the S&P 500 is basically one. It's basically NVIDIA.
I think it's really interesting, actually, now that you guys are sort of quibbling on this, to think about Google, which, especially towards the end of the year, the stock really started soaring because people saw it as an AI stock, which is interesting because when ChatGPT first came out and when AI, first became clear it was going to be this big consumer product, it looked like Google was the big loser. It looked like, Google, AI is clearly going to displace search. That's where Google makes all its money. Therefore, AI is going to crush Google. And now here we are at 2026, and Google is perceived as an AI stock, an AI company, and no one is really saying.
Isn't this a little bit of Schrodinger's equities here? It sort of doesn't matter what the underlying revenues are if people perceive it as an AI company. That's what's going to drive market value.
I'm going to push back a little bit on what Emily is saying here. I think undoubtedly Google had a good year in the stock market. But I'm not sure that there's anyone out there who considers Google to be an AI company where, I want to buy the AI story, therefore I'm going to buy Google. I think you're absolutely right, Emily, that the AI risk to Google is very much on the downside rather than the upside. That, we have already seen AI in general and ChatGPT in particular eat a lot of the search market, and that number is going to go up, and Google's homegrown Gemini AI isn't cutting the mustard, and there are big problems to Google's revenue model, insofar as we're entering this world of AI, and they're struggling with that. And I think that it is interesting to me that the stock did well in the face of those problems, and I would just push back on the idea that it did well because suddenly everyone changed their mind and said, oh, now Google is an AI company now. I don't know anyone who said that.
Well, we had a piece in Axios, I believe, because people realized, Google could have released a product like ChatGPT back in 2022, but it didn't because it was just more cautious. The argument I've seen is that they have the technology, they have the expertise and the know-how to do AI if not just as well as OpenAI, then perhaps even better. And they have the infrastructure and they have the cash flow. So I think there were people towards the end of the year being like, oh, hang on, wait a second. This company like has a lot of the stuff that it needs to triumph ultimately.
Yeah, but if
OpenAI.
you think about it, like, you know, if OpenAI is kind of the market leader in terms of valuation, right? And OpenAI is worth, you know, who knows how much it's worth, but call it $500 billion. And Google is worth what, like $3 trillion, something like that?
Some bajillions.
You know, so like, even if you give Google's AI expertise credit for being worth like as much as OpenAI or even more, most of Google's value is not AI.
I don't think you have to go that far. I think, you know, if we look at the overall composition of the index, maybe it's useful to look at who the losers are, you know, and
Yes,
right now
who are
it's
the losers?
Consumer staples, retail, and managed care. And that's all because people have less money to spend. And they're a little bit pessimistic about the outlook given a weakening labor market and expectations about interest rates.
And also just to be clear, like all of those companies are coming down from, if you rewind to a year ago, you know, where we were at the beginning of the year, which was a very healthy stock market. And one of the reasons why I continue to insist on being impressed by the performance of the US stock market, all of these asterisks notwithstanding, is because it had already been on such an amazing run that rising even further, even in percentage terms, but, you know, mostly just in absolute terms, is kind of impressive. You don't get like back-to-back years like that almost ever in the stock market. It's very impressive. And so, yeah, like, are there some stocks that went down rather than up? Yes, I mean, there always are. But if you look at the level of those stocks that you're talking about, most of them, the consumer staples, the fast food, whatever, yeah, so you can pick out individual stocks that are doing really badly. But the sectors in general, they still don't seem to be, they don't seem to be pricing in massive pessimism. They're just not pricing in as much optimism as they were a year ago.
Yeah. But like you said at the outset, something feels wrong. Something feels not kosher, right? We have this AI bubble. Everyone's a little stressed about it. We have like gold and silver doing super well because people are afraid maybe they're using it as a safe haven, unclear. Yet we have crypto doing not well. Would you think it would be doing well?
Well,
because
crypto is a
people perceive it risky.
prime example of what I'm talking about, right? Is that, yeah, again, if you're looking directionally, crypto is down rather than up from its highs. I think it's still up for the year, though, right? I think Bitcoin is like went up in 2025 rather than down. We should check that.
It's down 6.6% for
all
the
right.
year.
So, like, you know,
Yeah.
by Bitcoin standards, that's basically flat.
Back in the fall, it was like 120K, and now it's like 89.
Right. But, you know, if Bitcoin is one of the most volatile asset classes in the world, if it's down 6% for the year, that's like, that's within, you know, that's like a day's move.
It's been on quite a journey because if you're watching
always
on YouTube, up, down, up. Okay.
But yeah, like, so exactly. My point is that if you compare these things to where they were at their all-time highs, there are things that are well below their all-time highs, and Bitcoin is definitely one of them. But if you just take a step back and say, like, Bitcoin is worth $80,000, that's like completely insane and ridiculously high.
Well, I think, you know, some of the pessimism outside of, you know, things like Bitcoin, and this is leading into our next segment a little bit, has to do with things like the, you know, juxtaposing the U.S. markets against the global markets and looking at these countries who are trying to rebalance away from the U.S. because of tariff uncertainty, policy uncertainty, things like that. It's like, you know, how does that affect the companies in the index who are not primarily AI or perceived as being AI companies.
Well, or more to the point, how does that affect, when we were a little bit earlier, we were talking about should we be looking at the Russell 2000 or the S&P 500, and I was saying, like, I'm looking at the S&P 500. If you look at the Russell 2000, that is, you get many, many more sort of purely domestic American companies in there. In the S&P 500, it's nearly all global companies, and if, Germany starts making big domestic investments because they want to reduce their reliance on the United States, that's fine for like a big American company that has a lot of operations in Germany, right? They can just keep on, keeping on there. And globally speaking, companies are doing pretty well. And actually, I do think that one of the reasons why the S&P 500 is doing relatively well is precisely that all of those foreign revenues for S&P 500 companies are looking much more valuable now that the dollar has declined by 10%.
Yeah, I think that's why people feel bad and everyone is writing the story about the U.S. stocks underperforming international stocks because it's the first time that's happened since 2009.
Yeah,
apparently.
but you have to, like, it has to happen sometimes, right? I mean, like, I'm not...
Well, it's funny because I know, we don't really want to mention Trump here, but, the two biggest targets of Trump's trade war were supposed to be Mexico and China, and they've both come out winners, kind of. The MCSI China index is up 29% versus the S&P. And Mexico has made out really well in the trade war.
Yeah, Mexican stocks aren't doing that well. Chinese stocks are largely uninvestable. Honestly, like the smart move, if you're making the Trump play, my colleague John Others has this, what he calls hindsight capital column every year, where he's like, with hindsight, this is what I reckoned was going to happen, and it did. No, but the smart move was to basically say, J.D. Vance is going to piss off all of the Europeans and basically say that the United States doesn't give a shit about NATO anymore. This is going to cause the Europeans to massively increase their defense expenditure, and this is going to cause European stocks in general, but European defense stocks in particular, to go through the roof. And that definitely happened.
Yeah, that's true.
And, again, like I think of Chinese stocks in contrast as being... a little bit more like Bitcoin, to be honest. Like, number one, it's hard to invest in, and number two, they just move around all over the place for a whole bunch of reasons. I don't think that, Chinese stocks go up is a sign of, like, enormous health in the Chinese economy, so much as it's a sign of they had gone down so much that, it feels like dead cat bouncy. There's still a huge amount of bad debt in that country.
AI enthusiasm there, too. It's helping their markets as well.
Yeah, I mean, China has a strong amount, but again, that's the whole thing, right? Chinese companies, there are very few, if any, like pure play Chinese AI companies. It's all what I was talking about earlier, which is like AI is this sort of magic potion that you put into your P&L of whatever industry you're in, and then it makes you more productive and more profitable. And you can see that kind of optimism in China, and you can see that kind of optimism in a bunch of different companies, like my former employer, Thomson Reuters. Its stock is through the roof, because something AI something that no one can really explain, but like everyone's like, AI is great.
Is there a little bit of a chicken and egg issue there where it's, if you're a hyperscaler, you're one of the few companies that have the resources to really build up AI assets and infrastructure in a way that pure play AI companies that are starting from scratch can't? And that would be probably similarly the case in China. So it's sort of, are the hyperscalers primarily AI companies? Maybe not, but they are probably the only companies that have the resources to actually excel in the space.
Well, I mean, hyperscalers are, in a weird way, they're the sort of pick and shovel stock of the AI boom.
What's a hyperscaler?
The people building the data centers, basically.
People who can buy because they have incredible cash flow, and they...
So that so if you want to buy a bunch of compute, you're going to, in one way or another, be spending a bunch of money on these hyperscalers. And so yeah, they definitely count as a pure play AI stock along with Nvidia, but there aren't any $1 trillion hyperscalers.
Is that like Oracle?
Well, so Oracle is interesting, right? Because it's spending on hyperscalers, but it's also trying to build its own. And Oracle is also interesting because, you know, we've had this conversation in the past in terms of like, should we be worrying about a bubble? And there's like, you know, the front cover of Business Week is like AI bubble. It's, you know, so much bubble talk these days. But like, for me, the point at which you start really becoming worried about bubbles is when there's leverage, when there's like excessive leverage in the system. And certainly if you're looking at NVIDIA, Apple, Google, Amazon, you know, Microsoft, those companies have there's no real leverage in those companies. Oracle is the big exception. Oracle is the one that is actually going out there and borrowing hundreds of billions of dollars to try and invest, precisely because it doesn't have the kind of balance sheets that those other companies do. And it's like, it's most of its big AI related revenues are in the future. It's not really making the massive money right now. But yeah, I do think that even if you count, you know, Oracle, hyperscalers, Palantir, you know, and maybe a few others as relatively pure play AI stocks, and even Oracle, like Oracle has a massive legacy business that anyway, but yeah, even if you count it as an AI stock, I think it's hard to make the case that the stock market as a whole is rising on the strength of AI stocks. You really need to stretch and start making the case that companies like Google and Apple and Amazon are AI stocks. And certainly in the case of Google and Apple, I can't do it.
I think the bottom line is that the stock market went up a lot more than people thought it was going to go up, especially if you go back to April.
Oh, for sure. When the stock market was down 20% and everyone's like, the tariffs are going to kill the world.
Right. And instead of everyone being excited about this, everyone's like, "Ooh, this isn't good," especially because look what happened around the world. Everyone did better than America, and America's number one, and this is disturbing.
But you know,
blah, 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 Trump.
You know who's doing well? Line. And we do need to talk about this. The one Magnificent Seven stock that we haven't mentioned, bless him, is Tesla. And we just had another release on Friday of Tesla's quarterly vehicle delivery numbers, and they underperformed again, and they've been falling steadily for over 2 years now. And Tesla is just and I can't remember who said this, but like it's pretty clear at this point that Elon is bored with cars. He's just moving on from cars. And Tesla is an automaker, and so you'll be like, if the number of cars that it's selling is going down rather than up, and Elon is bored with cars, and no one thinks the cars are the future, obviously Tesla stock will be going down. But Tesla's all-time highs, and the company's worth $1.7 trillion or something.
Okay, my theory is that Tesla is partly a meme stock at this point, and the meme aspect of it is Elon. And I think he's my argument is not just that he's bored with cars. I think he's always been less competent than people perceive him to be. And now it's just sort of, now that Tesla's kind of hitting a wall and they have some problems that are a little bit trickier to fix, it's clear that he's not going to be able to come in. And
it's not clear, Elizabeth. $1.6 trillion of investors are saying the opposite. Like, it might be clear to you and it might be clear to me.
Because it's a meme stock.
No, but meme stocks are worth like $100 million. They're not worth $1.6 trillion. Like, these are big.
Oh, I think the same
these
dynamic
are big
can apply.
Institutional investors who are buying Tesla and who are owning Tesla. It's not a bunch. It's not retail.
That would not be the first time institutional investors bet on Elon and not really the fundamentals of the company. There are people that helped him buy Twitter, which made no sense. That deal made no sense from an economic
Correct, but that's exactly what I'm saying. Like, there's just such a huge difference between a $40 billion purchase of Twitter and a $1.6 trillion market cap for Tesla. Like, I feel like these distinctions, these orders of magnitude differences are important, and we should take them really seriously. Because yes, you can always find like a Kathy Wood or something who'll be like, yay, Elon's great, I'm going to buy the stock. But I don't think there are enough Kathy Woods out there in the institutional investor world to really explain this kind of valuation for Tesla. That said,
I think it's a major variable.
I don't have like a better explanation.
But it's obviously Elon
Well,
that makes Tesla's stock go up price, right? I mean, that's the explanation. We've discussed it a million times on this podcast.
But let's
haven't we? I mean, I guess I'm confused about what we're even talking about. I want to say one more thing, which is I was listening to an episode of Decoder Ring, which is a Slate podcast that's very good. And they were talking about like, what should we cover next year? What are some ideas? And their whole thing is like they talk about like mysteries that are right in front of you that you never thought about. Like they had a great episode once on like, why does everyone drink bottled water now? Like, how did that come to be? Because when we were growing up, no one drank bottled water. It was just like you drank from a water fountain or you waited till your meal and you had a drink. Anyway. One of the ideas that Willa had in this episode, she was like, we should do something on how like money doesn't mean anything anymore. Like, and then she kept talking. She was like stocks, they just like keep going up now and people just keep putting money into the stock market. And like, there's just so much, it doesn't even mean anything. And there's all these cryptocurrencies and like, that's not like, I just think something big is happening. This is very vague theory. And maybe it ties back to Tesla, I'm not sure. But like something big is happening now with money and valuations and enthusiasm about the stock market. And we thought, I think, that this year or 2025 was going to kind of like quash that, especially after April and Liberation Day. But then stocks just kept going up. So there's even more enthusiasm and there's even more like government policy trying to get everyone to put their money into stocks. And then there's like even more like enthusiasm and energy behind things that you think like shouldn't be worth anything or only worth what is in your brain about. Like crypto, the story of what it is keeps changing. Like it's a hedge against the dollar. No, it's a risk thing. Like it's a counterweight to the dollar. No, it's a store of value. No, like you're just making up narratives to fit whatever you want to throw the money at. It's like nothing means anything anymore.
No, I think the money doesn't mean anything. We are beginning to hear much more just over the past couple of months, at least in my experience, about the K-shaped economy. Like that meme kind of went away for a while and now it's coming back. And on the sort of upper leg of the K-shaped economy, you not only have Tesla stock and Elon being the richest man in the world and all of that kind of stuff, but you also have one of the things that I've been doing in my new job at Bloomberg is writing quite a bit about like, auction results at Sotheby's and Christie's. And you have, or Philips, for instance, where there was a $10 million watch that just got sold, which was like incredibly ugly. Or Christie's, where they sold a $30 million drinks cabinet in the shape of a rhinoceros, or, this kind of thing. Like there's a bunch of just silly money being thrown around in the world of the ultra rich in a way that feels kind of something. Money doesn't mean anything. Hey there! Before we get back to the show, I want to tell you about The Slatest, which is Slate's daily newsletter that lands in your inbox every evening. It's written by Slate's editor-in-chief, Hilary Fry, and it is the perfect way to end your day a little smarter than you began it. Every issue pulls together the sharpest stories, the most surprising news, and the can't-miss Slate podcasts, including this one, plus smart analysis and a bit of well-earned distraction. From DC to Hollywood to the algorithm, The Slatest keeps you clued in to the world and to Slate. You can sign up right now at slate.com/theslatest. We should just also touch on the sort of real economy rather than the financial economy, because I feel like the big sort of hidden surprise of 2025 in the face of like all of these headlines about Donald Trump imposing massive tariffs on Mexico and Canada and the world, but especially Mexico and Canada, is that he kind of didn't. Like, in his first term, he signed this thing called USMCA, which was the, rebranded version of NAFTA. And all of these tariffs that he's announced have been on the minority of trade with those two countries that don't fall under USMCA. And since the overwhelming majority of trade in North America is USMCA compliant, what that means is we wind up having effectively free trade between these three countries in most things most of the times. And this has been a big boom for Mexico because now, compared to the rest of the world, Mexican blended tariff rates are like 4% compared to everyone else's like 15% or whatever it is. And so Mexico feels like it has this incredible comparative advantage in terms of exporting to the United States compared to everywhere else in the world. And this has been wonderful for Mexico.
I think Claudia Sheinbaum gets the award for the world leader who has best managed Trump in terms of getting him to, pull back some of his policies that would have been detrimental to Mexico. But also there's a stat that says Mexico captured 25% of the U.S. trade deficit with China, which also seems kind of funny. The Chinese tariffs are actually benefiting Mexico.
That's what happened in Trump's first term. And that's what happened in Trump's first term. And since Trump's first term, Mexico has become the U.S.'s number one trading partner because, it's cheaper. I think the piece we read in the Wall Street Journal said the effective tariff rate on Mexican stuff coming into the U.S. is like 4% right now, compared with 37% for China. So a lot of U.S. companies are moving manufacturing to Mexico. They have a lot of manufacturers set up like right on the border to make it really easy to make stuff there. And I think, and to Elizabeth's point, Sheinbaum just announced that Mexico is doing tariffs on Chinese goods too, just to please, I think, the United States and just like to get on Team USA.
Yeah, Mexico would be importing a lot more Chinese cars if it was left to its own devices, because they want a bunch of Chinese EVs, and it's obviously good for the Mexican economy and the Mexican, consumer in terms of wealth and income is really quite close to the Chinese consumer, and it makes sense. And it doesn't have a huge domestic auto industry in the way that China does, but they're not importing those cars precisely because they're trying to stay on the good side of Trump. But yeah, do you remember a million years ago when people would talk about friend shoring? Like, we're in the post-globalization society, and we're just like bringing all of our trade to our friends. Yeah, that's what's happening. Like, North America is this trading bloc. It still is a trading bloc. USMCA is still in place. And that's good for Mexico. And I have to say, it's also good for Canada. Like, the Canadians are furious at Trump for various tariffs that Trump has imposed on Canadian exports. But the big picture is that the overwhelming majority of Canadian exports remain exempt from all of those tariffs because the USMCA. It's kind of interesting.
But meanwhile, lurking over 2026 is Trump going to pull out of USMCA? Because he has talked about it, and it is a worry for a lot of, U.S. businesses who have all rushed to Mexico as this like safe haven, and now are worried that, the rug will be pulled out. I think it won't happen.
I think this is a taco situation.
Yeah, because and the story of this year really has been taco. Like, I know people don't talk about taco anymore, but he's chickening out all the time. Like on New Year's Eve, he delayed for a year tariffs on furniture and lumber. As I was logging in to the chat today to talk to you guys, there was talk about pulling back on the pasta tariffs. Like, no one wants the pasta tariffs.
The pasta
like,
tariffs
I just
never
think,
made any sense.
We're all going to have ranzoni. Like, what are you doing? What? But yeah, so I mean, one of the stories also of 2025 of last year is just that tariffs weren't as bad, and most of the reason they weren't as bad is because of the talk of Trump.
Even the Swiss tariffs, like the 39% tariffs on Switzerland, they got cut like more than in half. They're down to like 15%. So all of those Swiss watch companies can breathe again.
Oh.
Phew. I know you were worried about them.
I was very worried about the watches.
But the other big story of the year, which we really should mention, was deal making, which was $4.5 trillion of deals, a huge amount of M&A happening globally. roughly half of which was in America. So like America was a major part of this, but it was everywhere in the world. It was definitely related to the broader stock market exuberance that we saw around the world. People are like, I have a valuable currency now in my corporate stock. I'm going to go out and spend it. I need to do big strategic things. Often those big strategic things are mergers, but interestingly, we are also seeing a record $1 trillion of divestments, right? These companies are doing big strategic, selling off massive subsidiaries. Again, partly because those subsidiaries can probably get decent valuations in the market, or from sellers, or from buyers, or whatever. So, yeah, after many years in which the profit engine for the investment banks was very much trading, it is now, the deal makers and the M&A stuff is a much, much bigger deal than it has been in a long time.
Isn't this in Europe? It's partially a response to Trump policy, because there's a perception that antitrust is not going to prevent any M&A activity here, but it's also strategic consolidation, abroad, and so to compete better with U.S. companies.
I mean, I feel like European companies are always going to want to compete better with U.S. companies, regardless of the antitrust situation in the United States. So like, if it makes sense to do it on a competitive level, just to compete with the Americans, then it would make sense to do it regardless of what the FCC and the DOJ were thinking.
Yeah, but isn't there like a little bit of a cultural difference where in the U.S. M&A is like an integral part of growth strategy, and then in Europe it's more of a last resort?
I haven't heard that. I'm not going to say it's false. I do think that for the big, again, if you think about, how like Netflix has put in this big bid for Warner Brothers, but that's the only real acquisition it's ever made in its history. Apple has basically never acquired anyone. There's definitely, there are definitely companies in America that have grown via acquisition, Berkshire-Hathaway being Exhibit A. Back during the dot-com boom, you'd have like Cisco buying a new company every 3 weeks. But I'm not sure that the sort of conglomerate model of like, we're just going to keep on buying things and rolling them up and finding synergies feels very contemporary U.S. capitalism. I feel that was much more of a 70s thing, really.
So let's talk about Berkshire-Hathaway, because, yeah, they're still really big.
They're $1 trillion company. Like, it's not just the mega cap tech stocks. There's also now a mega cap conglomerate in Berkshire-Hathaway.
And they're super conglomeratory. I just made that up. Thank you. They're
Mega
old
conglom.
school, mega conglom. They own a bunch of weird different things. And their CEO, Warren Buffett, heard of him. He finally stepped down at the age of 95. He thought, perhaps it's time for me to step aside and let the young blood take over.
The 65-year-old
so
Greg
guy,
Abel, who's like,
super young guy, 65, no problem. Greg Abel, will he be able to steward Berkshire Hathaway through this next chapter? If deal making was like so hot last year, why is Berkshire Hathaway sitting on a mound of cash, like a record amount of cash? It hasn't done
$380 billion, I think, at last count.
And then I was thinking like, okay, well, maybe they didn't want to buy anything because things are expensive, but what about they could sell stuff? They could get rid of
Well,
parts.
they could, but then they'd have even more cash. And in fact, that's what they've been doing. They've, like, remember that 50%, like, roughly speaking, Berkshire Hathaway is 50% companies it owns and 50% a pile of stocks. And it has been a net seller of stocks every year for the past 3 years. And that's one of the reasons why it has so much cash. It's precisely because they're like, this stock looks expensive, I'm selling. This stock looks expensive, I'm selling. And they keep on selling it, and then it just all goes into the pile of cash. Now, we should say that, interest rates were relatively high for most of the year. Bonds returned like a pretty healthy 7% domestically. So like, if you have cash, it's not like it's doing nothing. It's still making money. It's not making, stock market returns, but it's making decent returns. But everyone kind of expects interest rates to fall over the course of 2026. That's going to not only weaken the dollar, but it's also going to weaken returns on cash. And so that's going to increase the demands on Greg Abel to like, can you please do something with this cash rather than just keep it in cash? There is definitely a vibe out there in the ether that he's kind of waiting for another 2008 style crash. Like a lot of Berkshire's most successful investments happened in 2008 when he came in with like a huge amount of liquidity and rescued banks and did all these wonderful things and bought up, got warrants and everything. He made an absolute fortune by having a bunch of dry powder when things went to shit. And if there was a stock market crash tomorrow, you can be sure that Greg Abel would be out there, saying, I have cash, I'll buy. But like, I feel like wait for a stock market crash is not like a sufficient strategy, really.
I think there are two questions with regard to Abel. One is that, he's typically not been the person doing all the capital allocation. He's an experienced operator who's run several of the companies that Berkshire-Hathaway has bought. And that could be a big advantage because he might be able to spot opportunities that other people might not, apart from whether the companies are technically cheap or not. And then the second question is just that Buffett's whole investment shtick forever has been that he's a Benjamin Graham style value investor. So it is really the sort of buy cheap, sell high kind of stuff.
It's buy cheap and never sell is what he does.
Yeah, to a certain extent, yes.
They own so many companies. I was Googling while Felix was talking. No offense, Felix. They own NetJets. They own See's Candies. They own BNSF, the railroad.
Is the big one, along with Geico.
Geico. They own Fruit of the Loom, Duracell. Like, it's crazy. This is like very 1970s style situation. Like, are there other big conglomerates like this? There's nothing
anymore? Else compares to Berkshire. It is very, very much an outlier. To answer Elizabeth's question, like Greg Abel has said over and over again, yes, I will continue that style of investing. Like no one expects him to be a change agent. He is not coming in with a mandate to change anything. He's coming in with a mandate to just, what would Warren do, basically.
It's very like Tim Cook at Apple kind of thing. Like, just keep doing it.
I mean, well, Tim Cook is interesting because he came in as an operator, like, and the idea was that Steve Jobs was good at inventing things and bad at scaling things, and that like Tim's job was to do like maybe less inventing and more scaling, and he did that extremely well. In this case, everyone's just like, just do exactly what Warren would do. And to Elizabeth's point, that even includes investing in the stock market, which historically has not been his remit at Berkshire. But this guy, what's his name, Todd Combs, who just went to JP Morgan, was, he's like, no, you I'll go to JP Morgan, you take over, you do it. Warren has been like, if you know how to value a company for M&A purposes, you know how to value a company for stock market investing purposes. It's the same skill. He has said like that Abel is really in charge of all that. So we will see. But also, like, one of the other things is that an absolutely enormous chunk of Berkshire, like you've mentioned, Duracell and Fruit of the Loom and all the rest of it, is Apple. Apple is like the biggest company they own. They have this absolutely enormous chunk of Apple stock, which has done incredibly well for them. And like there's definitely been quarters where like their entire fucking return has just been like Apple stock goes up. And so like he's going to have to start getting comfortable with that kind of thing of just being so exposed to the vagaries of the stock market. But the other thing is that Berkshire, it doesn't pay a dividend, right? Even Facebook is paying a dividend now. Everyone is paying a dividend. Berkshire's the last company in the world to not pay a dividend. It has to take...
They did it once, and nobody
in 1967. So basically the standard thing that happens with companies that are throwing off massive amounts of cash is they use it on dividends and buybacks, right? Berkshire has done a few buybacks over the years, but it hasn't done any buybacks for the past 5 quarters because it thinks that stock is too expensive. And so like all of that money that would normally go to dividends is just piling up in the cash, which is what the other main reason why they have so much cash. And so they need the whole point of Berkshire is that it has all of this kind of quasi-dividend income that it needs to put to work, and it has all of this income from insurance policyholders who are like spending money on insurance premiums every month or every year, and that money needs to be invested as well. And so Berkshire needs to be a good investor. It needs to be constantly investing billions and billions and billions of dollars. And the big problem with Berkshire over the past couple of years is that it just hasn't been able to find anywhere to put that money. And, you know, to the first segment, I think the ultimate answer is going to have to be that Berkshire stops being quite as American as it is, and it's going to have to start looking internationally to make acquisitions, which is one thing that Warren Buffett was never particularly comfortable doing.
Or it's just waiting for the big crash, and like everyone should see this as like a leading indicator. If Berkshire-Hathaway has like so much cash and its whole strategy is waiting to spend the cash in a recession or a stock market plunge, then like maybe that's the signal and we should take that away. And maybe once the crash comes, they'll invest in all the companies, AI and otherwise.
We should have a numbers round. Emily, do you have a number?
Yes, Felix, I have a number. It is 480. That is the number of colors in the board game Hues and Cues, which I played over vacation and is really fun. And I want to talk about it and tell you the good news about Hues and Cues, because I know we talked about board games and how they're difficult to learn. And I heard about this board game on another Slate podcast, the Culture Gap Fest, I think a few years ago from Julia Turner. And it is a delightful game. It's so fun. It's super easy. There are these 480 colors on the board. And all you have to do is describe the color using a word that's not a color. You know, so you say like stop sign or something like that to describe a red. Or I said domino sugar to describe a certain yellow, things like that. And it's so fun and it gets you thinking and it's not too complicated and it's not based on luck really at all and easy to understand. And I recommend it for next year for all of you who will be at home.
I like this game too. And it's particularly fun to play if you happen to partake in edibles.
Good note. Great note. So yeah, 480 different colors. You can't play for too long because you're like, it's another yellow. Like, I don't know. But it's super
So wait,
fun.
do you have to say the name of the color?
No, you never have to say the name. You can't say the name of the color. It's prohibited. You have to describe the color using other words.
So like, you say dominant, and then I have a bunch of cards which have colors on them, and I need to like pull out the card that's closest to the color that you're thinking of.
Yeah.
Okay.
It's like the colors, the 480 colors are on a grid, like a map. So you pull a card and it'll have the picture of the color, but then it'll have its location on the grid, like A18.
I see.
A18. Okay. It's that special
And you
yellow
get little
right there.
pegs that you can put where your guesses are.
Yeah.
And you start sort of triangulating on where the specific hue is.
And it's fun because sometimes like you'll give your clue and you think it's like a really good clue. And then everyone puts their peg like so far away from the color. You're like, oh, I really fucked that up. It's kind of like writing where you like, I made my point. And then everyone takes away a completely different point from what you wrote. And you're like, damn it, I fucked that up. It's kind of like a real-time version of that in a way. It's really fun.
I'm just gonna do the obvious one. I apologize to all of the listeners for this one, but my number is 1 trillion, which is a dollar number. It's $1 trillion, which is basically the minimum amount that the United States is going to pay in interest on its debt in 2026. For the first time ever, we're going to have over $1 trillion in interest payments on Treasury bonds, which is, a lot of money. And I do think this also, going back to the K-shaped economy thing, like the people who own Treasury bonds who are receiving this $1 trillion of income every year. This is a flow. This isn't a stock. Normally when you talk about $1 trillion, we're like, Berkshire-Hathaway is worth $1 trillion. That's a stock. That's not a flow. This is $1 trillion per year and rising. Where's that money going? Well, a lot of it is going to, China and other big foreign holders of treasuries. But insofar as it's staying in America, it's probably just going to go to like stable coin owners. Yay. Elizabeth, what's your number?
My number is 8, and that's hours. And that's the amount of time an entrepreneur named Wing-Tan Wang, who runs a smartphone mindfulness app, spent sitting on a plastic stool, leaning against a door, doing nothing.
Was he raw dogging the sitting on the stool?
He was raw dogging boredom.
But can't you just do that by sitting in a plane seat looking at the map? Isn't that like what people have been doing like all year in planes?
Yes, then you're raw dogging your flight. Just to be raw dogging is a usually vulgar term that means doing something with no aids or protections. And so really other people do this and they just call it meditation, but for the super online set, this is raw dogging boredom.
So he just sat there or stood there?
Yes. You have no screens, no entertainment. You just have to think and daydream and maybe meditate.
That's tough.
Well, it's very stoic. The bros are very into stoics.
There's just not a lot going on up there, so they could just sit with it.
I think people are not used to, in the absence of screens, having to sit still for a minute and not do things.
Could you do that for 8 hours?
Not for 8 hours, but I did a meditation workshop at Esalen years ago because I was going to write about meditation and neuroplasticity. And after doing it for 4 days, I went from being able to like sit still for 5 minutes to an hour, which I thought was pretty good. And the hour went by pretty fast. So I think it's like a acquired skill in a way.
But is it a valuable skill?
Neurologically, it apparently is because it helps you focus. And
so, guys, yeah, that's it for Slate Money this week. You guys were doing the wrong thing.
Felix not impressed.
Instead of listening to 3 different people talking about their business and finance news of the week, what you should have done is just put on some noise-canceling headphones and listen to nothing for 55 minutes, because that would have been just much better for your neuroplasticity. It would have had fewer ads, though, and it would have made less money for us, so we can't really encourage this too much. But yeah.
It's anti-capitalist, clearly.
But I'm sure this, what's his name, Wing guy, has some kind of a startup where you can pay him money to do this somehow.
Oh, he does. Well, he has a smartphone mindfulness app.
There you go.
So he's making money from people doing literally nothing.
Yes.
I approve. But yeah, thanks for tuning in. Now it's 2026. We appreciate you. Thanks to Cheyna Roth and Jessamine Molli and Micah Phillips for producing. And stay tuned if you're a Slate Plus member. You're amazing. And we're going to talk about, Emily?
We are going to talk about Saks Fifth Avenue mulling bankruptcy and the future of luxury department stores. But also we are going to talk about Food 52 because we like that website and it's also going bankrupt.
Thanks for tuning in, and we'll be back next week with more Slate Money. And remember to check out the Slatest, Slate's daily newsletter. It's your daily update on the most urgent, surprising, and unusual news delivered straight to your inbox. A special thanks to all our Slate Plus members. If you haven't already, consider joining. Slate Plus members get unlimited access to all of Slate's journalism, plus they get ad-free podcasts, and they help support our independent reporting.